All right, what's common about this business is everyone has some support and resistance, lines in the sand. And people come up with them in different ways. So this video isn't about how to come up with them. It's how to use them in a comparing and contrasting fashion. Okay, so what you could expect to get out of the next few minutes will be just basic market and volume profile levels and some of the acronyms that profilers use. This isn't a course on profiling, but we like to take some of the common structure because it is a popular theory among those we trade against. And then we'll talk a little bit about edge alert levels, right? And how it's important to use them in different markets at the same time. So let's go over just some basic levels in both market and volume profiling. First of all, what's the difference? Market profile measures the amount of time a market will spend at a certain price. All right, so market profile is time-based, whereas volume profile will measure the amount of volume that a market trades at a particular price. So volume profile will keep track of essentially what's the most popular price. That particular price is called a POC, which stands for point of control. That simply means it's the price where most of the volume traded in that predefined period. So the POC for the day session could be 31 even in the S&P E-minis. That's where most of the volume took place. If the market spent its most time at that particular price, that would be the market profile POC. Another popular level or levels is value area high and value area low. They're standard deviations from the POC, but as really the edge not being really excited about math, we don't get into using math to figure out good levels of creating or executing a bias. However, it's simply the top and bottom of a bell curve. And let me illustrate that with these two images. If you look at the image on the right side, the S&P Mini Future, you'll see that we have a volume profile on the far right. And you can see how the bell curve kicks out and then releases lower. And that's the profile that they're talking about, where the top of the bell curve would typically be value area high and simply the bottom of the bell curve would be value area low. Somewhere in the middle typically is the POC, or where most of the volume traded. So you could slightly see it, that's highlighted over that particular bar right in here. Okay, so what's important is this is the S&P E-minis. It's a stock index, right? One of the more popular traded futures contracts. Its sister contract that we talk a lot about is the NASDAQ. So the NASDAQ has a POC, or point of control, right in there. So you see when this market rallies up, it stops and it uses the POC as resistance and then slides and goes lower. Wouldn't it be helpful if you were trading NASDAQ futures and you were using the POC as resistance and you were a profiler to also look what ancillary markets profiles are showing you? So for example, when you've seen the NQ go up to resistance and stop, you also seen the ES go into its POC, stop, and then sell off. That's what's unique. If you want to be like the masses. Now, market and volume profiling is a very popular theory and a way to understand the auction market theory and overall market structure. And we like it at the edge. However, you can't just analyze one particular market and profile the heck out of it. You want to be able to look at ancillary profiles of correlated markets, just like this example. That becomes more unique against the guys who are also profiling, because POC and value area highs and value area lows, those aren't secret levels. A lot of people understand those levels. The difference could be in instances where you get the complex testing their POCs. Now they're often stronger areas of resistance. And it's an edge or advantage that it gives you being a profiler over the others that are just looking at one particular market. That's the difference. And it's always about what's unique and what's different. And this is comparing, again, in this case, the POCs of different markets to find and create some semblance of an edge. We also try to compare are edge alert levels. Edge alert levels are levels that we create off of order flow. In the subsequent videos, we're going to get into detail about why it's important to use order flow or where other traders are trapped to find these levels. These levels aren't based on profiling. So if these two shaded areas, for instance, again in the ES on the right and the NASDAQ on the left, have two resistance levels. So these shades are resistance levels in the NASDAQ. Say they're alert levels, which are often bands or a cluster of prices, not just one particular price. And the NASDAQ walks up into it. You take a look at what is the ES doing? What is the Russell doing? What is the Dow doing? What is the Euro Stoxx doing? All these indexes from not just the US, but maybe abroad in Europe, right? If you're a 30-year bond trader, what's the 10-year note doing? Is it coming into an alert level area of resistance? And now you might get more bang for your buck in not only being able to use healthy supports and resistance, but comparing them across markets to find better locations and to help you build confidence in executing. Remember, as a community, what we often do is we learn about the enemy by understanding what their weaknesses are and trying to strip it out from what our weaknesses might be. And execution is a main weakness of most traders, both professional and retail. When professional traders go into a trading rut, it's because they're not executing well. They're missing something. So what's important is to get out of that rut ASAP. Retail traders never get out of it because they don't have that help. They don't know the right things to look at. In this professional prism that you look at it, you start recognizing not only better levels, accurately assuming where traders are stuck to create the levels, but comparing them across different correlated markets. That's what's important, and that's what your edge is going to be.